Your retirement account depends on a currency that just failed its most fundamental test. On April 2nd, 2025, when global markets collapsed and the VIX volatility index spiked to levels not seen since the COVID-19 pandemic, the United States dollar fell instead of rising. It dropped 1.7% in a single day. This is not how reserve currencies behave. For 75 years, when crisis hit, the dollar strengthened. When uncertainty spread, investors bought dollars. This pattern ended on April 2nd. Here's the data point that confirms the structural break. The dollar fell more than 10% against major currencies in the first half of 2025, while global financial stress indicators remained elevated. This inverse correlation has appeared exactly twice in modern history, during the 1973 oil embargo and the 2002 dollar crisis. Both preceded multi-year currency realignments. When the world's reserve currency stops functioning as a safe haven during periods of market panic, the question is not whether your savings will be affected. The question is how much purchasing power you will lose before the system finds a new equilibrium. I'm John A.G., and this is the Collapse Files. April 2nd, 2025 will be remembered as Liberation Day. President Donald Trump announced sweeping tariffs on virtually all United States trading partners, a baseline 10% duty on imports from 180 countries. Additional country-specific tariffs calibrated to bilateral trade imbalances. China faced over 50% when combined with existing duties. The European Union received 25% retaliatory rates. The scope was unprecedented in peacetime history. The market response was immediate and catastrophic. The Dow Jones Industrial Average fell 1,678 points. The S&P 500 declined 4.84%. The Nasdaq Composite dropped 5.51%. Within 2 days, American equity markets lost $6.6 trillion in value, the largest two-day loss in history. The VIX volatility index, known as Wall Street's fear gauge, spiked from 15.08 to 45.31, the highest reading since March 2020, when COVID-19 shutdowns froze the global economy. In every prior crisis since World War II, this pattern triggered dollar strength. The 2008 financial collapse saw the dollar gain 15% against major currencies as investors fled to safety. The 2011 European debt crisis drove the dollar up 12%. The 2020 pandemic shock generated a 9% dollar rally in 6 weeks. The mechanism was automatic and reliable. Global stress created dollar demand. Dollar demand drove appreciation. Appreciation confirmed safe haven status. April 2nd, 2025, inverted this relationship. As the VIX surged and equity markets crashed, the dollar fell 1.7%. Not against a single currency, against a trade-weighted basket of major currencies. The decline accelerated in overnight trading when U.S. markets were closed. By April 9th, when the administration paused the country-specific tariff increases, the dollar had lost 3.2% from its pre-announcement level. The drop did not reverse when markets stabilized. Through the remainder of April and into May, as the S&P 500 recovered its losses and the VIX fell back below 20, the dollar continued weakening. By the end of June 2025, the dollar index had fallen 10.4% from its January peak. The decline was broad-based, against the euro, down 11.2%. Against the Japanese yen, down 8.7%. Against the Swiss franc, down 12.1%. Even against the British pound, historically weak during global stress, the dollar fell 9.3%. The persistence of the decline matters. Temporary market reactions reverse when uncertainty recedes. Structural shifts persist regardless of short-term volatility. The dollar's continued weakness through May and June, after tariff fears had partially subsided and equity markets had recovered, indicated that Liberation Day triggered a fundamental reassessment rather than a panic-driven sell-off. Currency traders observed unusual patterns in overnight markets. When U.S. markets closed and Asian markets opened, dollar selling accelerated. The moves were larger than could be explained by economic data releases or news flow. The pattern suggested coordinated action by reserve managers operating during their business hours. Central banks typically avoid disruptive market moves, preferring to trade gradually over weeks or months. The fact that overnight volatility exceeded daytime volatility implied urgency. Forward currency markets also shifted. The one-year dollar forward rate moved to a discount against the euro and yen. This means that traders expected the dollar to be weaker 1 year forward than the spot rate implied. Forward discounts create incentives for corporations to hedge dollar exposure by selling dollars forward. When hedging demand increases, it creates selling pressure in the spot market. The spot weakness then validates the forward discount, creating a self-reinforcing cycle. Options markets priced in higher dollar volatility. The 3-month implied volatility for EUR-USD rose from 6.5% to 11.2%. For USD-JPY, volatility increased from 7.1% to 12.8%. Higher volatility increases the cost of hedging currency exposure. For multinational corporations with dollar revenues or costs, this creates budgeting uncertainty and margin pressure. Many responded by diversifying revenue streams away from dollar dependence. The mechanics of the decline reveal the structural change. Normally, when equity markets fall, investors sell risky assets and buy safe ones. U.S. Treasury securities represent the world's deepest and most liquid safe asset market. Treasury purchases require dollar purchases. Increased dollar demand drives appreciation. But on April 2nd, Treasury yields rose instead of falling. The 10-year Treasury yield climbed from 4.17% to 4.38% within hours, a 21 basis point move suggesting selling pressure, not safe haven buying. The 3-day period from April 2nd to April 4th produced the largest increase in the 30-year Treasury yield since 1982. Yields rise when prices fall. Prices fall when selling overwhelms buying. The data indicates that foreign holders of Treasuries were selling rather than buying during the crisis. This is the opposite of safe haven behavior. If global investors no longer view Treasuries as safe during stress, they do not need dollars to buy Treasuries. Without that structural demand, the dollar loses its crisis bid. George Saravelos, global head of foreign exchange research at Deutsche Bank, summarized the situation in an April 9th note to clients. We are witnessing a simultaneous collapse in the price of all U.S. assets, including equities, the dollar versus alternative reserve currencies, and the bond market. The word simultaneous matters. In typical crises, these assets move in opposite directions. Equities fall while bonds and the dollar rise. The fact that all three fell together signals a confidence problem rather than a cyclical market correction. The International Monetary Fund's COFAIR data provides additional context. The dollar's share of global foreign exchange reserves stood at 56.92% in the third quarter of 2025, down from 57.08% in the second quarter. The decline appears modest until placed in historical perspective. The dollar represented 67% of global reserves in 2004. The 10 percentage point erosion over 2 decades averaged 0.5% per year. The 2025 quarterly decline extrapolates to 0.64% annually, a 28% acceleration in the pace of de-dollarization. Reserve managers do not make impulsive decisions. Central banks plan currency allocations years in advance based on structural factors: trade patterns, debt sustainability, political stability, rule of law. The fact that reserve composition shifted measurably in 2025 suggests that April's events triggered reassessment of these fundamental assumptions. When the world's central banks begin reducing dollar exposure during the same quarter that the dollar fails as a safe haven, the two events are not coincidental. They are mutually reinforcing. The dollar's safe haven status rests on 4 pillars. The first is economic size. The United States produces approximately 25% of global GDP. This creates natural dollar demand for trade settlement and investment flows. The second is financial depth. U.S. capital markets represent 40% of global market capitalization. Liquidity in Treasury markets exceeds $600 billion daily. No other market approaches this scale. The third pillar is rule of law. Property rights protection, contract enforcement, and independent judiciary create confidence that assets cannot be arbitrarily seized. The fourth is military and diplomatic power. The ability to project force globally and shape international institutions ensures that the dollar's role is protected through both economic and strategic means. These pillars create a self-reinforcing cycle. Economic size generates trade denominated in dollars. Trade generates foreign exchange reserves held in dollars. Reserves are invested in treasuries, providing low-cost funding for U.S. fiscal deficits. Low-cost debt supports consumption and investment, sustaining economic growth. Growth attracts more foreign capital. Capital inflows strengthen the dollar. A stronger dollar makes imports cheaper, supporting living standards. The cycle continues. But the cycle depends on confidence. If foreign investors doubt that dollar assets will retain value, they reduce exposure. Reduced exposure means less treasury buying. Less treasury buying means higher yields. Higher yields increase U.S. debt service costs. Higher debt service widens fiscal deficits. Wider deficits require more borrowing. More borrowing must be absorbed by a smaller pool of willing lenders. The cycle reverses. The safe haven function operates as the system's shock absorber. When crisis hits, the flight to dollars temporarily overwhelms the concerns driving long-term de-dollarization. This buying surge stabilizes treasury markets and prevents funding crises. It provides time for policymakers to respond. The United States has relied on this mechanism through every major shock since 1945. Liberation Day demonstrated that the mechanism no longer functions reliably. The breakdown creates cascading effects through the financial system. Insurance companies hold $2.3 trillion in treasuries to back policy liabilities. When Treasury prices fall during crisis instead of rising, these portfolios experience mark-to-market losses precisely when claims may spike. Pension funds manage $6.8 trillion in assets with significant Treasury allocations. Lower Treasury prices reduce funded status ratios, forcing higher contribution requirements from sponsors already facing economic stress. Money market funds hold $4.5 trillion in assets, much of it in short-term treasuries and repo agreements backed by treasuries. If Treasury market liquidity degrades during stress, money market funds face redemption pressure they cannot meet without realizing losses. The 2008 experience with the Reserve Primary Fund demonstrated how quickly money market instability can freeze the broader financial system. The dollar's failure as a safe haven increases the probability of repeating that experience. Foreign central banks face particularly acute dilemmas. They hold $8.5 trillion in dollar reserves, predominantly in treasuries. These reserves serve multiple functions: intervention capacity to manage exchange rates, import coverage for essential goods like energy and food, and backstop liquidity for domestic banking systems. If dollar reserves lose value during crisis when they are most needed, all three functions are compromised simultaneously. The failure creates immediate practical problems. The United States runs persistent twin deficits, fiscal and current account. The fiscal deficit exceeded $1.8 trillion in fiscal year 2024. The current account deficit reached $950 billion. These deficits must be financed through foreign capital inflows. If those inflows slow or reverse, the financing gap forces adjustment through some combination of higher interest rates, currency depreciation, spending cuts, or tax increases. Higher interest rates slow economic growth and increase unemployment. Currency depreciation raises import costs and reduces living standards. Spending cuts reduce government services and transfer payments. Tax increases reduce disposable income. All four adjustment mechanisms are politically unpopular and economically painful. The safe haven premium allowed the United States to avoid these adjustments by attracting crisis-driven capital inflows at low interest rates. Without that premium, adjustment becomes inevitable. The entities trapped by this shift are dollar-based savers, fixed-income investors, and governments with dollar-denominated debt. American households hold approximately $35 trillion in retirement accounts heavily weighted toward dollar-denominated assets. A 10% decline in the dollar's purchasing power erases $3.5 trillion in real wealth. Foreign governments hold $8.5 trillion in dollar reserves. Depreciation reduces the value of those reserves measured in local currency terms. Corporations with dollar debt face rising refinancing costs if Treasury yields increase due to weakened safe haven demand. Emerging market borrowers who issued dollar-denominated bonds cannot print dollars to service that debt. They must earn dollars through exports or attract dollar inflows through investment. If the dollar weakens against their currencies, the debt becomes easier to service. But if the loss of safe haven status triggers risk aversion that reduces capital flows to emerging markets, the funding squeeze intensifies despite currency movements. The dollar index provides the clearest measure of the currency's performance. The DXY index tracks the dollar against 6 major currencies: Euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. The euro comprises 57.6% of the index, making EUR-USD the dominant driver. On January 2, 2025, the DXY stood at 107.98. By June 30th, 2025, it had fallen to 97.16, a decline of 10.2% in 6 months. This move ranks among the largest 6-month declines in the past 3 decades. The Asian financial crisis of 1998 produced a 9.8% drop. The dot-com collapse of 2002 generated a 10.1% decline. The 2008 financial crisis saw initial dollar strength, followed by a 14.6% fall in the subsequent year. What distinguishes 2025 is that the decline occurred during a period of elevated global financial stress rather than after crisis resolution. The correlation between the dollar and the VIX index quantifies the behavioral shift. From 2000 through 2024, the correlation between daily changes in the DXY and the VIX averaged positive 0.31. When the VIX rose, the dollar typically rose. When the VIX fell, the dollar typically fell. This positive correlation reflected safe haven demand. Between April 2nd, 2025 and June 30th, 2025, the correlation turned negative 0.18. The dollar fell when volatility rose and rose when volatility fell. This inversion defines the loss of safe haven status. Former Federal Reserve economist Steve Kamin constructed a regression model linking the dollar to interest rate differentials and market volatility. The model predicted dollar behavior accurately from 2010 through March 2025 with an R-squared of 0.68. After April 2nd, the model residuals exceeded 3 standard deviations for 7 consecutive weeks. The dollar behaved like an emerging market currency rather than a reserve currency. By late May, the pattern normalized, but the multi-week deviation indicated a fundamental disruption. The Bank for International Settlements tracks currency usage in global foreign exchange markets. The April 2025 triennial survey showed the dollar on one side of 89.2% of all trades, down from 90.1% in 2022. The decline appears small, but represents the first decrease since 2001. When measured in absolute volume, dollar turnover remained flat, while total forex turnover increased 12%. This means the dollar lost market share to other currencies, primarily the euro and Chinese renminbi. Gold provides a mirror image of dollar confidence. As the dollar weakened in spring 2025, gold surged to record highs above $5,000 per ounce. The correlation between gold and the dollar typically runs negative 0.40. When the dollar strengthens, gold falls in dollar terms. When the dollar weakens, gold rises. Between April and June 2025, the correlation strengthened to negative 0.62. Gold behaved as the anti-dollar, attracting flows that would have historically gone to treasuries. Central bank gold purchases accelerated. The World Gold Council reported official sector buying of 863 tons in 2025, the highest level in 3 years. Poland increased reserves from 229 tons to 550 tons. Turkey added 27 tons. China reported 27 tons, though actual purchases likely exceeded 100 tons given the pattern of unreported accumulation. These purchases coincided with reduced treasury holdings by the same countries. The substitution of gold for dollars in reserve portfolios provides direct evidence of de-dollarization. The dollar's share of international payments fell to 47.6% in May 2022, according to SWIFT data, down from 49.1% in December 2024. The euro's share rose to 23.8% from 22.7%. The Chinese renminbi reached 4.7% from 4.2%. These are not dramatic shifts, but the direction is consistent and accelerating. Each percentage point represents approximately $100 billion in monthly transaction volume shifting to alternative currencies. Treasury market liquidity deteriorated during the April crisis. The bid-ask spread on 10-year notes widened from 0.7 basis points to 2.3 basis points. Market depth, measured by the order book volume at best bid and offer, fell 40%. These metrics indicate that when sellers appeared, buyers were less willing to step in at narrow spreads. Reduced liquidity amplifies volatility and increases the cost of issuing new debt. For a government borrowing nearly $2 trillion annually, even small increases in financing costs compound rapidly. The 1973 oil embargo provides the closest historical parallel. In October 1973, Arab oil-producing states imposed an embargo on countries supporting Israel in the Yom Kippur War. Oil prices quadrupled from $3 per barrel to $12. The United States faced both energy shortages and currency crisis. The dollar fell 10% against major currencies in 6 months. Gold surged from $100 to $180 per ounce. The mechanism was similar to 2025. External shock, the oil embargo, created economic uncertainty. Normally, uncertainty drives safe haven demand for dollars. Instead, the embargo revealed structural weaknesses in the U.S. economy, dependence on foreign oil, rising inflation, expanding fiscal deficits. Foreign central banks questioned whether the dollar could maintain value given these pressures. The questioning became self-fulfilling as reserve diversification accelerated dollar decline. The resolution took years. The Plaza Accord of 1985 formalized dollar depreciation to correct trade imbalances. The dollar fell 50% against the Japanese yen and German Deutschmark between 1985 and 1988. American living standards stagnated as import costs surged. The adjustment was painful, but eventually restored competitiveness. Manufacturing employment stabilized. The trade deficit narrowed, but the dollar never fully recovered its pre-1973 dominance in reserve allocations. The 2002 dollar crisis offers another precedent. Following the dot-com bust and September 11th attacks, the U.S. current account deficit widened to 5% of GDP. Foreign central banks, particularly in Asia, accumulated massive dollar reserves to prevent their currencies from appreciating against the dollar. The accumulation funded U.S. consumption, but created the imbalance that would later reverse. Between 2002 and 2008, the dollar fell 40% against the euro. The decline occurred gradually but relentlessly. Each attempt to stabilize met renewed selling pressure. The Federal Reserve cut interest rates to combat recession, reducing dollar yields relative to alternatives. The yield differential turned negative against the euro and pound. Without a yield advantage and facing fiscal deterioration, the dollar had no support. The 2008 financial crisis temporarily reversed the decline. The collapse of Lehman Brothers triggered the sharpest flight to safety in modern history. The dollar rallied 15% in 3 months. This response confirmed that safe haven demand could still overwhelm structural concerns during acute crisis. The April 2025 failure to replicate this pattern suggests that the structural concerns have finally exceeded the safe haven reflex. The British pound's loss of reserve status provides a longer-term template. Sterling represented 55% of global reserves in 1945. By 1975, the share had fallen to 10%. The transition was driven by fiscal crisis, imperial decline, and the rise of alternative currencies. Britain fought the transition through capital controls, borrowing from the International Monetary Fund, and austerity programs. None prevented the inevitable adjustment. The key pattern from all three precedents is that reserve currency transitions occur over decades, not years. The process is not smooth. It involves periods of crisis, temporary reversals, and political resistance. But once confidence breaks, each subsequent shock reinforces the shift rather than reversing it. The dollar's April 2025 failure marks the beginning of this process, not the end. The mainstream narrative attributes the dollar's April decline to tariff policy uncertainty. This explanation is true but incomplete. Tariffs created the catalyst. The underlying vulnerability was debt sustainability. The United States federal debt exceeded $36 trillion in 2025. Debt to GDP ratio reached 128%. Annual interest expense approached $1.2 trillion. These metrics alone do not cause currency crisis. Japan's debt to GDP ratio exceeds 250% without crisis. The difference is credibility. Credibility depends on the belief that debt will be serviced through economic growth and fiscal discipline rather than inflation or default. The Trump administration's combination of tax cuts, spending increases, and tariff revenues created doubt about fiscal discipline. The Congressional Budget Office projected that current policy would add $15 trillion to the debt over the next decade. Interest costs would consume 27% of federal revenue by 2034. These projections assume no recession and no significant increase in interest rates. If the loss of safe haven status raises Treasury yields by 100 basis points, annual interest expense increases by approximately $280 billion on the $28 trillion in outstanding debt. That increase exceeds the entire budget for veterans' benefits. It forces a choice between cutting programs, raising taxes, or accepting even larger deficits. Each option has political constituencies that will resist. The resistance creates policy paralysis, which reinforces the credibility problem. The second-order effect involves the Federal Reserve's independence. President Trump has repeatedly criticized Fed Chair Jerome Powell for not cutting interest rates more aggressively. The administration floated the concept of a shadow Federal Reserve that would provide alternative monetary policy advice. Treasury Secretary Scott Bessent and National Economic Council Director Kevin Hassett suggested that the Fed should accommodate fiscal policy by maintaining low rates even if inflation remains above target. These statements erode confidence in monetary policy independence. If markets believe the Fed will subordinate price stability to fiscal or political objectives, inflation expectations become unanchored. Unanchored expectations increase long-term interest rates as investors demand compensation for inflation risk. Higher rates accelerate the fiscal crisis they are meant to prevent. The feedback loop is self-reinforcing. The narrative around de-dollarization focuses on alternatives: the euro, renminbi, gold, even cryptocurrencies. But no alternative currently matches the dollar's combination of economic size, market depth, rule of law, and military power. The euro faces its own structural problems with fiscal integration. The renminbi is not freely convertible and remains subject to capital controls. Gold cannot scale to finance modern commerce. Cryptocurrencies lack price stability and legal tender status. The absence of alternatives does not mean the dollar is secure. It means the transition will be chaotic. Instead of a clean switch from dollar to euro or renminbi, the world may fragment into regional currency blocks. Trade within blocks occurs in local currencies or bilateral arrangements. Trade between blocks requires complex clearing mechanisms or gold settlement. This fragmentation reduces economic efficiency and increases transaction costs. Global growth slows as the benefits of dollar-centered trade networks disappear. The loss of safe haven status affects liquidity first. When reserve managers and institutional investors reduce dollar allocations, they sell treasuries. Treasury sales push yields higher. Higher yields increase the cost of financing U.S. fiscal deficits. The Congressional Budget Office estimates that a sustained 100 basis point increase in interest rates adds $2.8 trillion to the deficit over 10 years. That assumes no behavioral response from lawmakers or markets. In reality, higher borrowing costs force fiscal adjustment. The adjustment occurs through spending cuts, tax increases, or both. Either option slows economic growth in the short term. Slower growth reduces tax revenue, partially offsetting the fiscal savings. The result is a grinding adjustment process that takes years to complete and reduces living standards throughout. Confidence breaks before liquidity. The April 2025 events demonstrated that global investors no longer automatically assume dollar assets are safe during crisis. This assumption change is irreversible without fundamental policy shifts. Tax reform, spending control, regulatory predictability, and monetary policy discipline could restore confidence over time, but the political system shows no evidence of producing such reforms. Without reforms, each subsequent crisis will test confidence again, and each test will likely result in further deterioration. What breaks first, historically, is the currency peg system. Many emerging markets maintain semi-fixed exchange rates against the dollar. These pegs work when the dollar is stable and serves as a reliable store of value. If the dollar becomes volatile and loses purchasing power, the pegs become untenable. Countries must choose between importing dollar volatility or breaking the peg. Most will eventually break the peg. The breaking of pegs creates cascading instability. Capital flows reverse as investors anticipate currency devaluations. Governments burn through foreign exchange reserves defending pegs. When reserves deplete, the devaluations occur suddenly and violently. Corporations and banks with dollar liabilities face balance sheet stress. The stress spreads through the financial system. What begins as a U.S. credibility problem becomes a global liquidity crisis. The trust dimension extends beyond economics. The U.S. dollar's dominance has provided geopolitical leverage through sanctions, swift exclusions, and asset freezes. Russia's reserves were frozen after the Ukraine invasion in 2022. This action demonstrated to every country that dollar assets are conditional on political favor. The lesson was clear: diversify or accept vulnerability. China, in particular, has accelerated diversification. The cross-border interbank payment system now processes renminbi transactions independent of SWIFT. Over 100 countries participate in renminbi swap arrangements. The Belt and Road Initiative finances infrastructure in 60 countries using renminbi-denominated loans. These are not immediate threats to dollar dominance. They are long-term alternatives being constructed systematically. On April 2, 2025, the United States dollar fell 1.7%, while global financial markets crashed. And the VIX volatility index spiked to crisis levels. This inverse correlation between market stress and dollar performance marked the end of a 75-year pattern. For 3/4 of a century, crisis meant dollar strength. The flight to safety was automatic and reliable. Liberation Day broke the pattern. By June 30th, 2025, the dollar had fallen 10.4% against major currencies. The decline occurred during a period of elevated global uncertainty and accelerating central bank gold purchases. IMF reserve data showed the dollar's share of global reserves declining to 56.92%. SWIFT payment data showed the dollar's share of transaction volume falling to 47.6%. Every metric pointed in the same direction. De-dollarization was accelerating. The implications are structural, not cyclical. The dollar does not lose safe haven status during one crisis and regain it in the next. Once confidence breaks, restoration requires fundamental policy changes that address the underlying vulnerabilities. Those vulnerabilities are fiscal. A $36 trillion debt growing at $1.8 trillion annually with interest costs consuming ever larger shares of revenue. They are monetary. A central bank facing political pressure to subordinate price stability to growth and fiscal accommodation. They are institutional. Trade policies that disrupt supply chains and alienate trading partners. None of these vulnerabilities will resolve quickly. Fiscal consolidation requires sustained political will that does not exist in the current environment. Monetary policy independence depends on norms that are being actively challenged. Trade relationships take decades to build and can be destroyed in months. The damage from Liberation Day extended far beyond the immediate market crash. It revealed that the pillars supporting dollar dominance are eroding. The path forward is determined by choices not yet made. If policymakers recognize that safe haven status is not permanent and implement reforms to restore credibility, the dollar could stabilize at a lower but sustainable level of dominance. If policymakers continue current trajectories, assuming that the dollar's status is guaranteed by inertia, each subsequent crisis will accelerate decline. History suggests the latter is more likely than the former. The British pound dominated global finance for a century before losing that status between 1945 and 1975. The transition was not smooth. It involved multiple currency crises, IMF intervention, capital controls, and significant reduction in living standards. The United States may avoid the worst outcomes through economic size and military power, but it cannot avoid adjustment entirely. For the individuals whose savings are denominated in dollars, the purchasing power question becomes paramount. A 10% currency decline is not a number on a screen. It is a 10% reduction in the real value of retirement accounts, college savings, and future income. The dollar index fell 10% in 6 months. If that pace continued for 5 years, the cumulative decline would exceed 40%. Compounding does not work in favor of depreciating assets. This is not financial advice. This is data observation. The data shows that the mechanism which protected dollar savers during previous crises failed during the most recent crisis. The failure was not momentary. It persisted through the quarter and into summer. The structural indicators suggest the failure reflects fundamental shifts rather than temporary dislocations. The hidden data they do not want you to see is that safe haven status is not guaranteed. It is earned through policy discipline and lost through policy failure. April 2nd, 2020 marked the transition from one state to the other. What happens next depends on whether the lesson is learned or ignored.